The South African economy has safely exited a technical recession. This as the economy expanded by 2.2% in the third quarter against analysts' expectations of a 1.9% rise. Manufacturing and agriculture, which had previously been sectors responsible for the contractions we saw in the first and second quarters, actually helped boost the print this time around, while mining continued to slump. Will we be able to hold on to the gains we have seen, though? Maarten, Ackerman, chief economist at Citadel, joins us with his perspective on what the numbers suggest about the trajectory for this economy moving forward. Thanks so much, Maarten, for joining us in studio this evening. So, as I say, we've had GDP climb, pulling South Africa out of a technical recession. What's your assessment of the quality of the growth we've seen?
Yeah, we had a very tough year, so I would like to put a positive spin on it as we entering Christmas season, festive season. So I think the number will be good for confidence altogether. If you add to that the fact that the petrol price is going to decline quite a bit, hopefully that will just lift the mood a little bit going into the last part of the year. But the reality is, yes, it's a good number, and we need more of these kind of numbers because that's exactly what the rating agencies are focusing on. But your question is about sustainability, and I think that, if we look at some of the underlying components, there's a lot of base effects coming into play. Although the agricultural sector was now the second biggest contributor, we know that came from a very low base. But if you take the confidence numbers that came out today in the agricultural sector, I don't think we can expect that to continue going forward. So it's going to be a challenge to keep these numbers where we are right now until we get proper foreign direct investment or local investments for that matter. So if you look at the numbers today, gross capital formation, that was again down 5% quarter on quarter. That's another negative quarter, and so there is no evidence yet that all the policy and all the incentives trying to attract investments into the country is actually working yet. So we still need to see that happen going forward.
Absolutely. So not working yet, and there are still significant risk factors to consider as we venture further down this path. I mean, just today we had expropriation without compensation taking another step closer to being a done deal, and we saw just how quickly the rand reversed course today from a position of strength to one of weakness. Talk us through your perspective on the kind of risk this brings into the entire equation.
Yeah, I think where we are right now, let's go back to the investment story. So we know that we need investments in the economy to really kickstart and have more sustainable and more inclusive growth going forward. So I think President Ramaphosa's focus on fixed investment and the investment summit is exactly the right thing to do. And if we just look at the numbers again, when he came in earlier this year, he said he wants $100 billion over 5 years. We now committed close to $50 billion. But that's only a commitment yet. And I think where we are right now, as soon as that money can really flow and get to the bottom line, it will have a major impact on the economy and job creation. But back to your question about the land, I think there's two things right now that's still keeping investors on the side. The one is certainty around land and property rights, and the election outcome next year. So I think a lot of people are saying, well, we're so close to May, let's just wait and see what's going to happen. And it doesn't really matter what the outcome is in the election, it's just to have, after that, we've got certainty, then we know what we're dealing with. So those two issues are still very much preventing a lot of the capital to actually being invested in the economy.
You mentioned those being two significant risks. So what about Eskom and a load shedding that's currently underway? Because mining and manufacturing sectors are heavy energy users, and that's likely to affect any potential growth we can see within those two spaces moving forward quite considerably.
So I think Eskom as a state-owned enterprise, well, we can probably start with all the state-owned enterprises, is still a major risk for our fiscal situation. So even if we get some growth and we can increase revenue, even if we can have the new boards be much more proper in management, less corruption, we sit with a legacy of debt in all those state-owned enterprises. So we will need to find a way to actually deal with that. If you think about SAA on its own and you look at the different routes, a lot of those routes are actually profitable. But when you look at the whole entity altogether, what are you doing with the debt? So we're talking about debt restructuring or ways of dealing with that. Back to the Eskom situation, yes, that is very unfortunate at this point in time. If we are running blackouts and the economy year on year, not this quarter, is doing 1%, then it tells me that if we want to get to the 3% growth, where we can really start tackling the structural issues, I'm not sure whether Eskom will be able to provide that for us. So we will need to look at alternative sources or really fast-track fixing up the power supply in terms of being able to support manufacturing, agriculture and the likes.
Do you see this putting the brakes to an extent on President Cyril Ramaphosa's investment drive? Because as you say, 50 billion committed, 50 billion still to go.
It's one of the things, you know, if you ask foreign investors, why don't you invest in South Africa at this point in time, they've got a long list of reasons. But in the top 5, it is about infrastructure support, whether it's electricity supply or water supply. So this is something that if you think about someone wanting to open a huge factory, unless they provide it on their own, which I think is also a potential going forward, they're probably not going to invest. So this is definitely a major headwind in terms of really getting that investments to actually make an impact on the bottom.
And we see it reflected in some of the numbers also, because we've had household expenditure increase by 1.6% in the third 3 months of the year. Government expenditure up 2.2%. Gross fixed capital formation contracting 5.1%, and that illustrative of exactly what you're highlighting.
If you think the gross fixed capital formation, that's the indication that there's no fixed investment taking place. You can add to that construction and electricity, that is also a negative for the quarter. So that is important components as part of the growth engine of the economy that we don't see. The positive is the fact that the consumers are delivering 1.6, because earlier this year we were really worried that the consumer is on their knees, you know, with the VAT increase, the petrol price increase, high unemployment. So yes, it's a positive number. It at least shows that there's still some life on the consumer base. And for an economy like South Africa, we need to remember that we're still a consumer-based economy. So 60% plus of the economy is driven by the consumer. So if we see that positive number coming from that part of the economy, that is a positive trend to watch going forward.
Let's leave it there, Maarten. Always a pleasure. Thanks so much for having joined us in studio this evening. That, of course, Maarten Ackerman, who's Chief Economist at Citadel.